Welcome to the monthly 3-Edge View from the Edge for March 2025. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and with me here today, special guest, my colleague Dr. Bob Phillips, filling in for our regular View from the Edge host Eric Beagleisen. Eric is away this week speaking at an investment conference. So a lot to cover today. Let's get started. And, as we turn the calendar into March, a pause in market momentum, investor psychology, along with softer economic data, some weakening in business and consumer confidence, and the constant overvaluation, at least by our measures, are all weighing on U.S. equity markets. And these factors, combined with volatility surrounding Trump's administration's multiple announcements on tariffs on some of our country's staunchest trading partners, which could lead to trade wars, a resurgence in inflation, and even the prospect of stagflation. All of this has the folks on Wall Street and investors, frankly, quite nervous. And this was evident in the past week where we saw the VIX, which is the Wall Street's fear gauge, that reached the highest level since December of last year. And so with all this uncertainty, with the volatility, it's going to be helpful to hear what factors our model is picking up on. So let me turn things over to Bob. And he'll review our 3-Edge asset class matrix and point out the changes that we've seen since the prior month. So thanks for joining us, Bob, and over to you.
Thanks. Great to be here, Fritz. Yes, since the last month, it's been interesting. The big changes have really come outside the U.S. in that we've seen a move from a rather mixed outlook in both Europe and emerging markets to a more positive outlook, and we'll get into a few more details in a moment about that. But that's been an interesting move. We've also seen China move from a somewhat mixed status to a slightly more negative status. And again, an interesting development, all interlinked with the things that Fritz mentioned going on in the U.S., as you can imagine. So, Fritz, I'll turn it back to you, and we can start to go through some of the details.
All right. Well, great. Let's dig in and go through these asset classes. And let's start with U.S. equities. So, had a difficult week here the last week. So it'll be interesting to see what is the model picking up, or what is the model telling us about the outlook for U.S. equities at this point?
Yeah, I think as we've been talking about for a while, the U.S. market has been very overvalued on our metrics, and had really been predominantly driven by momentum factors and behavioral factors to higher and higher levels. That has really fallen off very dramatically, and markets hate uncertainty, frankly. And certainly over the past several weeks, there's been a lot of uncertainty introduced, particularly with the impact of tariffs, along with some mixed, sort of mixed results in the economic data. Not huge changes there, but interesting changes that have decreased some of the attractiveness of U.S. equities. In conjunction with that, we've seen a lot more volatility in the long-term Treasury yields, which can indicate a sort of an increasing risk of a slowing economy here in the U.S. Again, it's just been a volatile time across the board in all the U.S. Components of the market.
So, yeah, I mean, it definitely feels like that vibe, if you will, has definitely backed off from what we saw in 24. So let's now shift and we'll look at the ex-U.S. equity markets, beginning with Europe, which have really started off the year with a bang. So what is the model telling us at this point?
Well, Europe's been very interesting because up until recently, the European yield curve had been extremely inverted. There were incredible fears of problems with growth, stagnation. But what's been happening is with a lot of the uncertainty here in the U.S., the European countries, particularly Germany, has decided they need to step up to a number of challenges that will involve them providing what ultimately will prove to be a lot of fiscal stimulus in the markets. Now, the market has been anticipating that, and the German market's up over 20% for the year so far. But it really has come with some other interesting things. One of the big things this week is that there was a really rapid rise in the 10-year bond yield, sort of that hadn't happened since the reunification of Germany, really long time, and does lead our models to show more positive opportunity in Germany. However, having said that, there's really a lot of this. The early stages of this growth in that market has been momentum driven. So there could be some choppiness and volatility as we go forward in that space.
Excellent. So now let's shift gears, go all the way over to Asia, take a look at Japanese equities, where oftentimes I find most of the conversation centers around the yen. But what is our model research picking up for Asian equity?
Yeah, we're still not seeing a lot of much of a compelling case for Japanese equities. There has been an increase in the steepness of the yield curve there, but not anything like what we've seen in Europe, for example. And the big negative that's a pretty big negative that's overwhelming some other positive contributions. For example, the credit spreads have stayed pretty narrow there, and that's usually a sign of some potential growth. As you mentioned, the yen is also something that's very interesting and to watch. The yen has been strengthening a bit recently. Not always the best thing for a country that relies a lot on imports, and particularly there hasn't been a lot of talk about tariffs in Japan from the U.S., but the uncertainty in the sort of global trade market could also be a bit of a braking factor in Japan unless they continue to allow their currency to absorb some of that.
All right, great. All right, so now let's go and look at the emerging markets in China. You had mentioned them, Chinese equities earlier. What are we seeing across that universe of the emerging markets with China?
It's really been driven by China. And this is a big wild card. Clearly, if you look at the threat of tariffs on China, unlike the situation with Mexico and Canada and the U.S., the Chinese tariffs there doesn't seem to be any give in backing off of that situation. Now, the Chinese have historically found ways to work within that framework. By basically letting their currency devalue and absorbing some of those costs. But the other thing that's been offsetting and frankly been driving the market is a recognition on the part of China that in this changing global environment, they really are going to have to stimulate their economy. That's the reason we really moved it. The models have really moved into a more positive territory as we're starting to see action in that market that is often a leading indicator on the beginning of stimulative behavior on the part of the Chinese government. And again, much of that has been helping raise the other parts of the emerging markets as well. But it's really China that's been driving and dominating that.
All right. So our last equity asset class is India. What are we seeing there?
Yeah, Indian equities have really struggled. A lot of negative investor psychology right now that there had been a big run up last year and prior to that in the Indian markets, and that's sort of backed off a bit. The yield curve for government bonds is not steep enough to really cause this to be a positive factor yet. So we're not seeing early indications of stimulus. We're sort of past the election point now, so the government may or may not decide to introduce additional stimulus that would drive the markets higher. But having said that, with the threat of tariffs and other things hanging over their heads, it's yet to be seen as to whether the government will start to step in and the psychology of the markets will begin to move in a more positive direction as a result.
All right, excellent. So that'll do it for the equity asset classes. So we'll shift attention now to the bond market and the interest rate environment and look at the Treasury, U.S. Treasury market, which, like the stock market, is seeing a bunch of uncertainty and volatility here. What is the model telling us is happening in the U.S. Treasury market at this point?
Yeah, the model has been a little bit more positive on the longer end of the yield curve recently. Again, because we've seen somewhat of a collapse in the long end yields, but also because as stimulus is withdrawn from the U.S., things like tariffs get applied, there's enough uncertainty in the market that particularly the long end of the bond market tends to move with uncertainty towards lower rates. Now it's a battleground because on the one hand, there's still a sort of underlying fear of inflation, in which case people would would demand a higher rate for the bond in order to purchase it, and also there's the tariffs can drive many of the offshore buyers of bonds to behave differently. But the flip side is there's a concern about the slowing of the economy a bit, and that again drives the long end down. So it's really an interesting time. But I think for right now we've been using tips to really help us extend the duration slightly in portfolios, and that's really what the model has been calling for.
All right, great. And so what about the corporate bond market, or often referred to as the credit markets?
I mean, that's a really interesting one because often, typically, if you were going to see a softening economy, you'd see a widening in spreads. We've seen a slight widening, but we've been at historically tight levels and we continue to be there. And so you're not getting much yield over risk-free treasury rates, and makes that market a little bit less interesting right now. We'll see how that plays out if this uncertainty continues.
Yeah. If the economy continues to soften, those spreads could gap, really. So interesting. All right, let's look at the asset classes that we refer to as hard assets or real assets. That includes both gold and commodities. Let's begin with gold, which not only outperformed the S&P in 24, is off to a strong start here this year. So what is the model indicating for the outlook for gold?
Yeah, right now the model is positive on gold. Some of it's momentum driven because again we have had a good year. It's up about 10% for the year compared to other markets, and I think that tariffs, if they become a source of inflation, clearly will drive interest in gold, and also other countries as they begin to have to make adjustments to what tariffs imply, particularly if they start to work. Their currencies may be a pretty solid market and have been a pretty solid market for gold. So right now our models are quite bullish on gold, and it looks like based on the other factors in the model that may continue for a while.
It's exactly what you said about China, because you think you're doing something to another country by imposing tariffs, except that other country's currency is then going to come down and devalue and take away what you thought you were getting from the tariff. So it's very interesting. So let's stay in the real asset, hard asset area and look at commodities, which I think is another interesting area based on what's going on.
Yeah, it's a very interesting area. And again, a lot of it is wrapped around the action in the U.S. The pressure from the U.S. government to try and decrease oil prices has had an effect. The Saudis have agreed to pump more oil. There's certainly more oil going in, and there's a push to get more oil pumping here in the U.S. That's driven down the price of oil, and we've seen that in the price action of commodities. We've also seen, and our models are really picking up right now, a fairly negative view on commodities, and that a lot of that is a result of this. Some of the things we're seeing in the yields, the changes in yields that indicate the potential for a softening of the economy. If the economy softens, prices will go down. One thing that's important to understand is that while tariffs may increase the purchase price to individuals of a commodity, the actual price of the commodity may come down to adjust for that. In other words, so the price may not go up as much as the tariff would indicate because the price gets forced down in order to accommodate that. There's a lot of interesting dynamics around commodities, but I think the bigger overriding theme is that it will be a push and pull between the potential softening of the U.S. market, which is a huge market for commodities, and the potential demand that may come in from stimulus being applied in other countries.
Wow. All right, great, Bob. So that takes us through all of the major asset classes. And thank you very much for providing the update. You're very good at connecting the model to the current events that we're experiencing. So I think everyone will find this to be very helpful. And actually, I've spent the last month plus out traveling a lot. I've met with a lot of advisors, investors, and I can tell you, investor uncertainty is much higher. There's really a lot of fear now being generated since we turned into 2025. So again, I think it's helpful to hear what our research model is picking up and telling us about the outlook for the remainder of the year and beyond. So that will do it for this month's 3Edge View from the Edge. Eric Beagleisen and I will be back again in early April with another edition of the monthly View from the Edge. And if you'd like a hard copy of the View from the Edge newsletter, which we publish on a monthly basis, you'll find that on our website at 3edgeam.com. Also, our entire video library is on our 3Edge YouTube channel. Please feel free to share it if you think someone could benefit from it. And if you find it to be helpful and informative, please feel free to subscribe to our 3Edge YouTube channel. So, on behalf of today's special guest, my colleague, Dr. Bob Phillips, and everyone here at 3Edge, thanks for listening.